Today's Mucker Growth Series session is on the topic of finance and financial planning, specifically for startups. My name's Tony Yang. I head up the growth team here at Mucker Capital, which again just basically means that I have the privilege of spending a lot of time with our founders to talk about and guide them on growth and go-to-market strategies. Today, our repeat guest, expert and speaker is Debbie Rosler, who is a fractional CFO at Burkland Associates, one of our partners, and they are a fractional CFO, accounting, back office type of service provider. So Debbie, great to see you again and great to have you. Definitely looking forward to your presentation today. So I'll hand it over to you.
Great. Thank you so much, Tony. And it's really great to be back here again. So as Tony mentioned, I work as a fractional CFO at Burkland, and my firm provides outsourced finance, accounting, tax, and people operations support to venture-backed startups. We work with just over 800 startups at this point. And I've been at Burkland for about 10 years working as a fractional CFO. My current area of focus is working with enterprise SaaS companies. As a firm, we work across a broad range of industries. But you'll notice that a lot of my examples today will be a little SaaS-centric, given that that's sort of what my area of expertise is. And overall, I have over 25 years of finance experience. I've worked on dozens of financial plans over time, so definitely have been there, done that across the full range of sort of early stage startups up until later stage, public size entities. So have a pretty strong depth of experience working on financial planning, and look forward to sharing some of that with all of you today. So to kick it off, just to run through the agenda of what we're going to talk about, we'll be running through sort of the overall objectives of annual financial planning, and then we're going to spend some time diving into the design of a financial planning process. So what is it that you need to do to sort of get the team all aligned and work together on building a financial plan? Then we're going to dive into the deliverables from a financial plan and sort of go into some of the details on what it is that you're actually going to end up with as the output from your financial plan. And then finally, we'll talk about how you execute on the financial plan throughout the calendar year. So while the planning exercise tends to be an end of the year process, the ideal is that you're leveraging this plan throughout the full year. So to kick it off, I want to first talk about sort of, what are your objectives in terms of building an annual plan? And, obviously a key focus is that you're looking to set goals for the business. Financial plans set specific measurable financial goals for your startup. Having these clear objectives help to ensure everyone's on the same page and allows you to measure your performance throughout the year against the targets that you're setting. It also helps you to determine your allocation of resources. So it requires a company to take a holistic look at your financial picture, including your revenue, expense, your cash runway, and your fundraising plans. And in doing so, it forces you to make strategic decisions on where to invest the limited resources that you have. Cash runway management and understanding what your runway is a key objective of financial planning. As you're building a financial plan, it should include monthly cash flow projections, which will ensure you understand what your runway is. So when exactly do you expect to be running out of cash? When do you need to start initiating and closing on your next fundraise? And particularly in the current climate over the past few years, where fundraising has become much more challenging, it's critically important that companies have really solid visibility to the runway and a really proactive fundraising plan. Organization alignment is another key goal of pulling together a financial plan. It really serves ultimately as a communication tool within your organization and helps align teams' efforts, providing transparency around financial goals and priorities. So the ideal is that, regardless of who's involved in the planning process, whether it's a small team or a larger team, the ideal is that the goals, the overall targets are shared broadly throughout the organization, so everyone's working towards the same goals. Contingency or scenario planning is another key objective of financial planning. So by building these forecasts and scenario plans, startups can anticipate potential challenges that you're going to be facing and plan for contingencies and levers that you're going to pull if you face those situations. So that helps to reduce the impact of any type of unexpected financial setback. And then finally, financial plans help to build investor and stakeholder confidence. So a well-prepared plan demonstrates that your company has a clear understanding of your financial situation and a strategy for achieving your objectives in a very tactical way. And that can instill a lot of confidence among your investors. So any questions on this slide? Okay. So with that, I want to dive into a little more around what a financial planning process actually looks like, and also how it can vary based on the stage of a startup. So the approach to building a financial plan can and should evolve as your startup grows and scales. So when you're at the earliest stage, and if you look on this chart, I break it out into what I call small, medium, and large. Small would be sort of the earliest stage when you start doing a financial plan. So somewhere maybe around the seed stage, you should be thinking about having a financial plan. Mediums, when you get to be sort of a little later, start having, department ownership, and you might be maybe a Series B, Series C stage company. And then large would be sort of, you're still a private company, but it's a much, much larger organization at that point, sort of pre-IPO. But what you should see is at the earliest stage, the financial planning process should be quite simplified and streamlined. So the time invested in it, the resources should be low. It likely at that stage may only involve, the CEO, the finance lead, possibly some exec staff. It's likely something that at the early stage might be completed in Excel, maybe only have 1 or 2 iterations. And that's something, because of the shorter process, you can probably start the planning process a little later time frame. And so the examples I give over the next few slides on the timeline assumes a December fiscal year end. I know a lot of startups have different fiscal year ends. Several of my clients have had January fiscal year ends, for example. So just know that the timelines I'm sharing here are based on December. So adjust accordingly if you have a different fiscal year end. But what you'll see is the small process for a small company maybe don't start until the November timeframe. I call the really early first plan most companies do tends to be sort of a 2 per people in a room with a whiteboard, sort of roughing out your strategies, roughing out your plans, doing it in a really streamlined fashion. But as your startup grows, the planning process starts involving more people and requires more coordination, effort, and iterations. So for example, when you hire your first sales lead, they'll likely be a key contributor to the sales plan and will need to be tightly involved in the planning process. And as the startup grows, it's eventually going to introduce department level ownership of P&Ls. So that would be department leads that would own their own budget and resource allocation. So head of your R&D team would be managing the budget for their own team. Head of sales, same thing. Product, all the different departments would have ownership over, what their teams look like, what the staffing is, and would be closely involved in the planning process. And so that at that point, by the time you have these department leads, you need to factor in a more of a coordination to the planning process over a larger group of people. And so you're going to need to build out a more detailed calendar that's going to outline process, milestones, roles, and responsibilities. So everyone's really clear on who's responsible for what work, what the end product's going to look like, and really clear on the timelines for when that's all going to be pulled together. And at this sort of like medium stage, what you often see is that, it's still a finance-led process, but it's heavy CEO involvement as well as the department leads that are working on it. Because of the more extensive requirement for coordination, you need to back up the timing to be starting it, probably in the October timeframe. So giving yourself maybe a 3-month window to be doing planning. So, for those of you that are at, larger companies, Series B, Series C stage, starting planning now is definitely a good idea. At the medium stage, some of the tools startups use, you can still be using, a lot of startups do continue to still use Excel, Google Sheets for planning. Google Sheets enables a little more collaboration than does Excel a lot of times. But having said that, there's a lot of tools that are being introduced these days that are cost effective for early stage startups, and it can start making sense to implement some of those tools. Some that I've seen in the past include Girard and Finmark. There's other ones that are launching every day. I get calls constantly from these companies that are out there that are building these tools, and there's definitely ones that are worth checking out. They really do a great job facilitating the collaboration that's involved as you get more and more people involved in the planning process. And then the coordination needs and resource requirements for financial planning continue to grow and expand as you grow to a larger, potentially multinational or multi-division organization. And so at that point, you're talking about a plan that's going to involve 25 or more people, all the department heads, but then it also filters down within their organizations. And as a result of that, the planning process often does need to extend quite a bit more. And you're also talking about sort of more enterprise level FP&A systems that can facilitate the planning process. So on the next slide, I'm going to talk about a little more details about what the planning process looks like for this medium stage, which I think is that's the stage when you first start bringing in that department level coordination. The reason I want to focus on that stage is that, like I mentioned, the small stage startup, that's sort of more the two people in a room, real streamlined process. So there's not all that much detailed process involved, but the medium stage is sort of the first time that you're needing to have more of a robust process built in. And so, as you can see on this next slide, this outlines sort of some of the key milestones and deliverables that are involved in a mid-stage startup financial plan. And so like I mentioned, this is sort of mid-stage once P&L ownership has been distributed to department and division leads. And you have a need to start coordinating it among a much larger group of stakeholders. So the first sort of key milestone in a planning process would be actually doing a design of the planning process. And so assuming you start around the October timeframe for a December fiscal year end company, the starting point for that is it's typically a finance-led process where you're designing, what is the calendar and milestones, deliverables, responsibilities for the financial plan. You pull together maybe the shell of a financial model, whether you're doing it in Excel or if you're pulling together a system-based tool that you're using, getting that all set up, pulling together sort of the templates and presentations that you're going to be distributing to be able to collect the inputs from the broader team, and then likely having a kickoff meeting where you're outlining the full process with the team. And so, like I said, finance is leading this process, but then starting to sort of distribute this out to the team. The next step is to set the top-down goals and initiatives. And this sort of starts with sort of a look at your key strategic priorities for the year. So some companies may have a long-range plan that they've already put together, or maybe even doing it as part of this planning process. But the idea is that a financial plan, an annual financial plan, has a lot that's very tactical to it, but it also should reflect not only sort of your specific plans for your current year, but also the longer range strategies that you're driving towards, and making sure that it takes into account investments and initiatives that may not even pay off in the current year, but figuring out sort of the long range strategies as well. So that's a key part of a starting point for setting goals and initiatives. And then another key starting point is to go through and build tops down targets. So based on your overall growth objectives for the business, what are your tops down revenue goals? In line with that, taking into account your fundraising plans, your cash availability, where you expect to have ROI on various investments. What are some of the targets in terms of investments in headcount and marketing, and some of the other key investments that you think at the tops down level, sort of, the CEO working with the CFO together, what are sort of some of the going in assumptions around what you expect that to look like that you want to share with the team. And then you also want to put together guidelines and guardrails for some of your investments. So, that could be things along the lines of, even, down to the idea of salary raises. What level of salary raises are we budgeting for? What are we thinking? What are the plans around promotions, headcount expenses? What are the targets for growth in various business segments? Those type of things can sort of set sort of the starting point for these are the targets that you want to work against. And based on those top-down targets, the teams need to come back with plans and provide some strategies on that. It can make sense at this early stage to also float the sort of initial top-down targets with the board as well. So while you're not going to go to get approval with the board of a plan until December or maybe even the January timeframe, it can make sense to at least vet the general top-down targets and make sure that what you're working for is aligned with the board's expectations, get inputs from them accordingly, and make some pivots at that point. And then once you've set this top-down goal and shared it with the teams, with the department leaders, then it's their turn, the department and division leads, it's their turn to go through and build up their bottoms-up plans. And they will work with their teams to build these detailed bottoms-up plans, identify key initiatives, and give them a few weeks to pull that together, and then come in and review their recommendations in a meeting with the CEO. So typically what you'll have is each department will have an opportunity to present their plans, key initiatives to the CEO. You'll pull everything together in a consolidated plan. You'll see if things are rolling up the way that it needs to. And then the negotiations begin if expenses are rolling up too high, which is a pretty common thing that you'll see in planning. Have some negotiations back and forth between the CEO, the CFO, and the department leads to make adjustments as necessary. Figure out if you need to prioritize key initiatives based on the available investments. So if you're hearing from department leads that in order to deliver on certain product initiatives or sales initiatives, they need to have a certain level of staffing and that's not in the budget, then you may need to, pull back on some of the initiatives or, look to find, resources to be able to invest. But that's all sort of part of the push and pull to sort of make the tops down and the bottoms up line up in a way that gets to sort of an acceptable final recommended plan. And then once all that's pulled together and you have sort of the recommended plan, then you go to the board and review the plan. Now I have this listed as being approved in the December timeframe, and that's a little bit aspirational is what I would say. I think the reality of what I see with startups is that most startups sort of have a preliminary plan that they review and sort of soft approve in the December timeframe. But given that that's probably going to be in the mid-December timeframe, given holiday schedules and everything, you're still not at the fiscal year end. And usually at minimum, there's some level of a recalibration in the January timeframe to fully finalize your plan. And what'll happen is if there's certain deals that didn't close that were expected to close at the end of the year, that might get pushed forward into the next year's plan. Vice versa, if there's deals that got pulled forward earlier, that might impact next year's plan. But the idea is that you want to have at least a prelim plan by the end of December, ideally, so that as you start the beginning of the next year, the full team has something that they're working against. The sales team knows these are overall the goals that we're working at, knowing that maybe there'll be a little bit of tweaking before it's finalized, but at least they have some targets that they're working with going into the beginning of the fiscal year. So, anyone have any questions about this planning process? Okay, great.
Keep going.
Okay. So this next slide is a eye chart detailed financial planning calendar. I'm not going to run through all this, but this presentation will be distributed, and I've gotten requests many, many times for someone to share a sample planning calendar that they can leverage. So, this is basically, built off of a calendar that I worked on with one of my clients and, obviously anonymized, but hopefully this is something that might be a helpful tool if you're looking for sort of some of the detailed steps in pulling together a financial plan. And now we're going to move on to the actual deliverables, the output that comes out of a financial plan. The core output is obviously the financial projections for the next fiscal year. And I'm going to review what's involved in putting together these financial projections. But I'm also going to double click down on the detailed components that make up the financial projections, including the revenue plan, the expense plan, and the cash plan. And I'm also going to discuss three related key outputs, which are KPIs, incentive compensation plans, and scenario planning. So to start, financial projections. That what should be involved in financial projections would be for the year should be a monthly income statement, balance sheet, and cash flow. And on the next slide, I'll show you sort of an example of what that will look like. The best practice is to adopt what I'd call a balanced or a 50-50 plan, which what that means is that, the plan has a 50% chance, you have a 50% chance of beating the plan, a 50% chance of missing the plan. So it's overall sort of balanced. You think it's a high likelihood, a reasonable likelihood that you'll be able to meet the targets. And you want to look at that sort of 50-50 for your revenue goals. Ideally, you'd like to have a little bit higher level of certainty, call it 70% or more for your profitability and cash flow, because bottom line, you want to, although there might be a little bit more risk in meeting the revenue, you want to make sure that you have a high likelihood of being able to meet cash projections, because obviously you're not able to sort of flip the switch too fast on changing cash runway. So you want to be able to sort of be conservative on that side as much as possible. The one thing I'd say is, like I say, that the sort of plan that you sort of set as your final plan is sort of that 50-50 plan. I'll talk later on in this presentation about scenario planning, where you go to the place of building other versions of the plan that maybe have, an upside that might have a harder potential to achieve, and then maybe a downside that has a higher likelihood of being able to meet the revenue plans, and sort of what the offsets that you put in place to manage cash on that as well. We'll talk about that in a few slides. In general, Excel or Google Sheets can be a good tool at the earliest stages for startups to build projections. So, if you're a seed stage startup, usually the first time you're doing planning, doing it in Excel or Google Sheets makes a lot of sense. The thing is that early stage, a lot of time the revenue model is still in flux, and you're fundamentally iterating on, how it is you're going to price the product. How are you segmenting the revenue? What are the markets you're going after? What's the time frame for billing and collections? All the factors that until you have your first set of sales, that you're not going to have a lot of understanding of. And so the nice thing about a tool like Excel is that it has sort of the ultimate flexibility that you can sort of build it and then rebuild it really easily. Having said that, as I mentioned, as you grow and scale, planning systems can make a lot of sense. And what I often see is sort of like a logical sort of switch point between an Excel versus a planning system is often when you get to the point of the departmental level budgets, where you're coordinating with a bigger group of people. A lot of times these financial planning systems can facilitate the collaboration in a better way than something like an Excel or a Google Sheets can do. So that can be the point. But having said that, there's more and more planning systems that are coming out these days that are more and more cost effective. So I think we're going to start seeing those planning systems, come in earlier and earlier over time. Definitely would recommend bringing in experienced finance support to build a financial model. You ultimately want to have your financial plans tie in with your chart of accounts, and that's something that an experienced finance person is going to understand how to line that up. But essentially, you want to make sure that whatever you put together in your plan, that you're able to track that against how you're actually reporting on an actual accounting basis. And so you want to make sure you have that linkage put together. And that's something that, someone who has experience in finance and accounting is going to understand how to structure that and pull it together. As a starting point for pulling together your financial projections, the starting point is going to be take a look at your historical revenue and expense trends. And that'll be sort of a beginning point for sort of trying to figure out some of the trends, some of the initial top-down targets. But then you're going to modify that sort of starting trend-based assumptions based on looking at what are the strategies the company is going after, where are you making investments, where are the growth objectives, and so you'll massage based on that. Any questions here?
Yeah, I'll jump in with a question, Debbie. In your experience with working with early stage startups, how frequently, if at all, have you seen financial projections being reforecasted throughout the year?
So, and I'll talk about this a little more at the end. Generally speaking, a robust financial planning and analysis process involves first that you set the plan at the beginning of the year, and then on a periodic basis, you're updating the outlook for the full year. So, and some companies might do that monthly, some companies might do that on a quarterly basis. But the idea is that you have a plan that you're working against, and that is your anchor, but you continue to update your outlook for the year that will diverge from your plan, maybe to the upside, maybe to the downside, but you want to continue maintaining a forecast outlook throughout the year, because particularly if you're runway, if you're managing to runway that's going to be running out during the current year, you want to have the most up-to-date visibility on what your runway is and what your performance is. And then also, as your actual results start to diverge off of your plan and your outlook for future performance starts to diverge, you want to make sure you're regularly updating sort of how are you reacting to that. So if your revenue is tracking ahead of plan, is it time to pull forward some of your sales hires, for example? If your revenue is tracking below plan, do you need to delay hiring some sales hires, or do you need to delay some of the other hires or pull back on marketing expense? But the idea is that fundamentally you're managing throughout the year to make sure that you maintain the net cash runway that you need to have, and adapting to changes in the business situation. So yes, you do want to reforecast. That's a muscle that you tend to put in place. I'd say many companies put in place sort of a more what I'd call robust financial planning and analysis process somewhere around the Series A stage. So what I tend to see is companies do their first financial model. If they don't have it sort of at the early seed stage, by the time they're heading into a Series A raise is often, by then most companies will have had their first financial model built, understanding their revenue model, the unit economics, building all of that out. And that'll sort of serve as the basis for their plan. And then once they raise their Series A after that, then they start putting in place the finance capabilities, whether it be with a finance hire or with a fractional finance hire, someone who's able to do that sort of reforecasting on a monthly or quarterly basis.
Great, thanks.
Yeah. Okay. So this next slide, I know it's an eye chart. Again, you'll get the slides itself, so you'll be able to see it a little more up close. But this gives sort of examples of what an income statement, balance sheet, and cash flow should look like as the output. This is bubbled up at the quarterly level. Like I mentioned, the plan itself should actually have monthly detail built into it, because ideally you want to be able to look at your performance on a monthly basis and see how you're tracking against plan throughout the year. But when it comes time to actually present it to the board, bubbling it up to the quarterly level can often make a lot of sense. Also, you'll see that the way that the financials are presented here, so the income statement presented, just a few different line items breaking out expenses. OpEx is broken out between research and development, sales and marketing, G&A. There's a lot of detail that would be built underneath this in your financial plan. So within R&D, you're going to have the specific headcount for different engineering employees, for product team employees. You're going to have the systems spending on that. For sales and marketing, you're going to have advertising expense and the sales team and commissions, and a lot of detail under that. But it's good then to sort of, when it comes time to sort of present it to your board, get approval, bubbling it up into these categories helps them to sort of view the financials in a more sort of standard GAAP format type of a way that people like to see, that the investors would like to see. And then I'm going to talk in the coming slides about building out the revenue and expense at a more detailed level, and how you'll want to think about that. So diving into some of the deliverables around the revenue plan, it often makes sense to build revenue plan at a driver's level. So instead of having a single line in your financial plan that looks at revenue and maybe looks at X% growth per month, you actually want to have sort of the bottoms up drivers build of what's driving the growth. Depending on the company, what your drivers are could look entirely different. So it could be based on volume and pricing for a variety of products. It could be based on the number of sales reps and what their deliverables are. The example that I have here is one that I've seen used for a lot of SaaS companies that I've worked with, where a lot of times the amount of revenue you're able to deliver is seen as tied very much to the number of enterprise reps that they have, what their quota is for sales, and then how ramped those employees are. So for example, a enterprise sales rep could have a quota of 1.2 million of ARR for the year, but maybe it takes them 6 months to be ramped in their role. So when you first hire an enterprise sales rep in the first couple months, maybe there's no sales, and then it starts ramping gradually. But you want to sort of make sure you're taking into account those types of drivers and factors as you're building your revenue plan. And what will happen is that these revenue drivers will become metrics, key metrics that you track throughout the year. So even though some of these drivers are not actually part of your financial systems, they're not something that you're going to see reported in your QuickBooks, they're still really important metrics that you want to say, hey, for the plan, we assume that people were able to, they have the quota of 1.2 million, and we're going to plan that everyone gets to 80% of their quota, or whatever the case may be. And then during the year, you're going to measure across your sales organization, what level of quota did people actually achieve, and are we measuring up against that, so that you can, number one, learn where there's performance issues and where adjustments need to be made, but then number two, also recognize, did we plan right, or were we overly aggressive in our assumptions or overly conservative? So that's a key thing that you want to look at, is sort of that driver-based revenue plan. The other thing that you want to look at is it can also make a lot of sense to break out revenue by appropriate segment or other relevant categories for your business. So, I've seen a lot of times SaaS companies I've worked with maybe are selling to enterprise, and SMB is a pretty common breakout that I see that we want to be able to track, or maybe it's geographic areas. And another thing that you'll see is sometimes it's growth components that you want to be looking at. So for a SaaS company, a lot of times you'll be measuring your annual recurring revenue, but you want to have a good understanding of, as that ARR is growing, how much of the growth is coming from new accounts, new customers, versus how much is coming from expansion from existing customers. And then how much is being offset by churn or contraction from existing customers. But understanding sort of the components of the growth is something that is helpful to understand what the plan for that is. And then when you actually sort of measure that growth throughout the year, being able to see whether you had a good understanding of what the drivers of your growth would be. So, if you expected 80% of your growth to be coming from expansion, but in reality it was 80% coming from new accounts, understanding those drivers definitely will have an impact on how you choose to allocate your sales and marketing resources and other aspects of your business. Okay, so this next slide sort of gives an example of a revenue broken out by a business segment. And one thing I'd say is that in terms of presenting your revenue plan, it's often really helpful to present it. A lot of times, things can be presented with graphical format, table format, variety of different ways. I find generally that revenue is a good one to present using graph, because it shows sort of trend lines over time. In this particular example, shows the segment-based revenue. You can see sort of an acceleration in growth in the out years, and then you can also, break out the actual percent growth that you have by the segment. And any question on revenue planning? Okay, so with that, I'm going
to have a comment. Maybe you have can also comment to it. So like something that I sometimes tend to explain to founders that are new to sales and revenue planning is signing a contract does not necessarily equate revenue on that day. Difference between bookings and revenue recognition. So do you have any comments about that in terms of how you plan out, this revenue, the revenue plan, for example, in the chart?
Yeah, and that's something that you see a lot, with enterprise SaaS companies, that they'll sign a contract, but it doesn't go live for maybe 6 months. There's a period for implementation. And so because of that, that's why SaaS companies in particular have a separate tracking of SaaS metrics from accounting metrics. So revenue is sort of more of an accounting metric, and that takes into account how much revenue you earned in a given month for contracts that have actually gone live. Whereas there is value to tracking what I'd call contracted annual recurring revenue, which is the value of the annual contract that you've signed that maybe has or has not gone live yet. And what I've done in the past with SaaS companies that do have sort of this long tail between signing a contract and going live is that I'll sometimes actually track 2 separate SaaS metrics. One which is called contracted annual recurring revenue, and that's the portion of the revenue that's signed as a contract. But then I'll separately track what I'll call just ARR, or live ARR, and that's the portion that's actually been signed and gone live. The discrepancy between the CAR and the ARR is the amount of the ARR that has not yet gone live. And so that is an important distinction. I would say that the CAR is a great story, particularly in early days. What you see is, I generally see that for companies seed Series A, CAR will be their sort of number one metric because it tells the story of the forward sales motion, and it's something that companies like to look at. But then as you get to be sort of a later stage company, the discrepancy between CAR and R starts sort of converging because you already have a really large base of business. And at that point, a lot of companies pivot to using ARR as their main metric.
And just to kind of double click into that, specifically for enterprise sales motion type of companies, let's just say, a company signs a multi-year large contract, 6-figure, 7-figure deals, but, the payment terms could be on a quarterly payment terms. Are you expecting the startups or the team putting together a revenue plan to basically break that out in terms of the payment terms forecasted for the future and then accounting for churn and stuff like that?
Absolutely, and that's really like one of the things that adds a lot of complexity to SaaS companies, all this variability around contract terms.
Yep.
So, if you have a company that's getting multi-year agreements, I mean, I've worked with companies that will get 3-year agreements and not only get a 3-year contract, but actually get payment for the whole 3 years up front. It's not always that common, but there's some companies that are able to do that.
Yep.
And that's where it's really critical to make sure that as you're planning for your cash flow forecasting, you get the benefit of this upfront. It's basically customers funding your business is the way to think about it. It's fantastic. You get that upfront payment, but you need to keep in mind as you build your financial models that you've already collected on that 3-year term. And so you don't want your financial models to be assuming that more cash is coming in until that renewal period 3 years later. So it is very important that when you're building financial models for SaaS companies, it takes into account the variability of these contract terms. And at the earliest stage, I've found, particularly for enterprise companies where they don't necessarily have a very large number of customers, but they can be quite large and often have a land and expand motion that'll grow quite a bit over time. I found it actually helpful to often, forecast the cash flow at the account level early on. Now that's something that later on gets to be more and more complicated, and then you'll start using more trend-based cash flows, looking at sort of patterns. But at the early stage where it could be really lumpy, it is often quite valuable to forecast at the individual customer contract level.
Great, thanks.
So diving into sort of the next key deliverable, that's the expense plan. And like I mentioned, you're going to want to double click down and build a lot of detail underneath what goes into your expense plan. For many startups, particularly SaaS startups, people-related expenses are often the largest expense category. And so as such, that's probably where you want to invest the largest portion of your time in terms of your planning efforts. So, a key thing is figuring out what are your hiring and staffing plans. So what's the headcount going to be by department? Where are you going to be making investments? And then compensation planning is another key thing that you want to be looking at as well. So, the annual planning is the time frame for you to be looking at salaries, benefits, variable comp, as well as equity, actually. So it's a good time to sort of, force that discussion as well. You want to take into account what are your plans around your cost of living and merit adjustments, promotions. There are some free tools out there that you can use to benchmark market rates. So, companies that, as you start sort of getting larger teams, you can use your annual planning process as a time frame to be looking at are your salary bands within the ranges of what you're targeting for your company, and using some of these outside tools as a way to benchmark for that. If you're a company that's been around for a while, looking at your equity plan is something to do. So a lot of startups will give an initial equity grant, but then as the company progresses, some of your longer tenured employees, you don't want their equity to be fully vested, and then they're not getting additional equity. So commonly, sort of once employees have been about 2.5+ years in, around that time frame, you want to start looking at doing equity refresh grants that will sort of continue to extend out the period of their vesting beyond that initial grant. And sort of looking at sort of using that as part of something that you do as part of the annual planning process. And you go to the board for sort of approval on that as part of the plan is a good practice as well. And then finally, executive comp is something that should be reviewed annually by the board. Later stage companies will have a compensation committee that formally does this. Earlier stage, even if it's not with a compensation committee, it should be part of what's reviewed. If nothing else, maybe at the closed session, but during the board meeting is something that you should definitely be reviewing. So that's the people-related expense. The non-people-related expenses also obviously need to be done. Worth doing a deeper dive on some of the bigger expenses items like marketing. If you're a SaaS company, technology and hosting, if you're an AI company in particular, that's a huge expense. Consultants, some of those bigger buckets deserve a deeper dive. Some of the other lighter expenses, looking at more of a trend line based level of spending can make sense. So looking at historically how much we spent, per salesperson on travel and applying that going forward, maybe making adjustments if there's specific changes you're making, but looking at that is something you want to do as well. Any questions here? Okay.
Yep, let's keep going.
Okay. Next key deliverable is around cash planning. So, as I mentioned, the financial plan, key output is that you want to have visibility to cash runway and when you're going to be needing to raise capital next. Now, it's not just the actual cash plan that's important, but it's also when is your cash out, and then backing that up to when you need to begin fundraising. So whether that's 6 or 9 months before your cash out date, is your performance at a level that you've achieved milestones that you're going to be able to be successful in a capital raise. So you look at sort of the time frame where you're going to need to begin your fundraising efforts, and you see, have we achieved the revenue targets that we think we need to be successful? And if you haven't done that, then you need to sort of relook at the plan and figure out what you need to do to adjust your runway, manage the business in a way that you can get to those milestones, those fundraising milestones before you initiate your fundraising efforts. Okay. So a next key deliverable from the financial plan is key performance indicators. So like we were talking about on the other slide, there are specific metrics that are not necessarily part of your financial statements. Some of the common SaaS ones I showed on this page. So ARR is a metric that is very similar to revenue, but not exactly the same. It gets more into sort of the bookings, and it takes into account sort of the annualized value of revenue, but not necessarily the monthly recognition. And metrics like this are something that's important to be one of the key outputs from your financial planning process, because it's something that that you're using as sort of the most important metrics on which you're measuring your business, and you want to be able to say, what did we expect it to be, and then how have the actual results come in throughout the year against what we expected. The other thing with KPIs, having those set as part of the planning process, is that a lot of times once you get to the point of having incentive compensation plans that are variable based pay, a lot of times you'll want to anchor the targets that people need to achieve against specific KPIs that are relevant to their specific line of business. Okay. So talking about incentive compensation plans, this is another thing that should be set as part of the annual planning process. So at the earliest stages, startups might not have an incentive comp plan. The earliest stage employee options is sort of the first set of incentive comp that's offered. Sort of, often it's at venture-backed startups across the board. Usually the first employee that has a cash-based incentive compensation plan, which would be commissioned, is often the sales team. They're the starting time, and a lot of times that'll be directly tied against their actual sales achievement. But then as startups grow, they may choose to more broadly offer variable cash incentive compensation with payouts tied to KPI performance that's related to areas that they're able to be that they're able to impact. And I've seen this happen. It can vary by stage when companies do this. I tend to see this being like a Series C stage, maybe late Series B is when a lot of companies start putting this into place. But it's good hygiene, and it sort of gets people aligned. Make sure it basically aligns people's financial incentives with what the business wants them to be focusing on. So the table below here gives an example of some of the metrics that might be measured for different functions. So, For example, the sales function obviously can, an enterprise sales SaaS company would be measured based on how much ARR are they closing for the business, whereas the customer success team, that would be more about are they doing a good job of retaining business and upselling it over time, perhaps. But depending on the business, what their function is, it can vary in terms of what the KPIs are measured on. And then one thing to note also in terms of incentive comp plans is that sales commission plans and other variable comp plans should be formally documented each year. So you want to make sure that everyone's really clear on what it is their exact targets are, what they're going after. And typically speaking, a sales comp plan will have like an actual sort of signed agreement that they'll have specifying exactly what their targets are, outlining the sort of rules associated with it. There's a lot of nuances that come to sales comp planning. So the more specific and detailed you can be in pulling together those guardrails, the better off you are, so that you don't end up after the fact in disputes with the sales team in terms of what commission should be. So as much clarity as possible is great. And this is why as companies grow, there starts often being sales operations teams that manage these types of processes because they can be quite complicated. Okay. And then this is the last sort of key deliverable we're going to talk through, which is scenario planning. And sort of the overall approach to scenario planning is that you want to identify some of the key uncertainties that you're facing as a business and bucket them into different scenarios. It's pretty common for companies to do 3 scenarios. So, what I've seen is often is an upside, a base case, and a downside. In recent years, where there's been a lot of volatility, I've seen maybe a base case, a downside, and a worst case. So it depends. But the idea is that you're pulling together what are the various scenarios that you're facing. Maybe it's sort of tied to some level of a revenue outlook. And then depending on what scenario you're actually heading into, what are some of the contingency plans or responses you have to each of these scenarios? So if your revenue is coming in higher than what you expected, what are some of the things you have in your back pocket to start, accelerating your sales growth or investing higher in your marketing spend? And then what you want to do is take each of the scenarios and build an actual financial model for each of the scenarios. So you'll have sort of your existing financial model for your base case. And then basically you want to create separate versions for each of the scenarios off of that. And then during the year, you basically want to be able to, be doing, like we talked about with Tony just before, you are going to be doing periodic reforecasting during the year. As your reforecast comes in and shows significant discrepancies off the plan on the upside or the downside, you got to figure out what are the trigger points where you start putting in place those contingencies. So you start pulling forward the hires or delaying the hires. What are the points that you start, enacting on those contingencies? So Quiet Capital had published a really helpful guide on forecasting and scenario planning. There's an exhibit from it that I have on this slide. It's linked on this page. So when this gets published, you'll be able to get the link to the slide. But net, I think this visual I found to be really helpful. It sort of shows the general idea of, the top rows are what are the revenue outlooks you're facing. The columns show what is the cost plan that the responses to the different revenue outlooks you're facing. And then the middle is sort of what's your runway, what's your cash outlook. Now, in this case, they had pulled this together sort of, I think, when the fundraising market first fell apart a couple of years ago, 2.5 years ago. And so they were trying to, convince companies to get to cash flow positive. I don't think that's necessarily what a lot of startups are going after these days. You are seeing companies trying to extend their runway to some extent, but companies are still investing. So, what green looks like isn't necessarily fully funded, but the idea is that you want to get each of those scenarios to a place of what would be green. And what green is, a favorable runway, is basically what runway do you need to have based on your revenue target to be able to successfully achieve your next fundraise. So depending on the scenario, a downside scenario runway may have to be longer than an upside scenario runway, because the upside scenario you're going to be achieving, higher revenue at a faster pace. And so you may only need, 6 months of runway, where if you're facing a downside, you have to double down on some of the cost savings because you're not achieving the revenue. And so you're going to have to wait even longer to raise the capital. So you'll have to cut even more expenses to extend that runway. So those are the sort of key deliverables in terms of the financial plan that I wanted to walk through. And then this last slide just quickly highlights how it is that you execute on your financial plan throughout the year. And this is a little bit of what I spoke about with Tony earlier with respect to forecasting. But the idea is that the financial plan gets leveraged on a monthly basis, at least. I mean, actually, it should be leveraged continuously, but at least from a financial process standpoint, you set the plan to the end of the prior year, beginning of the current year. And then each month, when you close your books, you look at your actual results for that month, for the year to date, and compare it against where the plan was. And then on a periodic basis, you look at a roll forward for the full year of the forecast and how does that the latest outlook for the current year compare against the plan. And like I said, that could be done on a monthly basis or on a quarter basis. And then the one other thing is that if you do diverge significantly off your plan, because the plan is a really strong anchor against which you're measuring the business throughout the year. And if you really diverge significantly off the plan, sometimes mid-year, and I've done this with some of my companies recently, that there's such a big discrepancy between what the original plan was and your latest outlook that you may do an actual sort of formal reset of the plan mid-year and sort of get that sort of approved by the board that, yeah, things have changed a lot. We're going to use this latest outlook as the plan against which we're going to measure ourselves for the balance of the year. So that's sort of the key content that I was planning to walk through. This slide outlines some of the key takeaways. I know we only have a few more minutes, so would love to sort of fit in a few questions if we're able to during that time.
Great, awesome. Yeah, so those of you who are still with us, feel free to type in your questions. Maybe we'll get to one or two. But let me ask a question on behalf of our very early stage, so pre-seed, seed companies, and essentially founders of companies at that stage. You covered a lot, right? Like financial statements and documents from balance sheets, income statements to cash flow and revenue projections, revenue plans, and then covered incentive planning as well as scenario planning for the pre-seed and seed stage companies. What, in your opinion, is the must-haves? Because they could get overwhelmed, right? And so I guess the question is, what are the core priorities for that stage? Because we do have a lot of portfolio companies at that stage. And, what it would be, again, this is not the right way to say it, but what's good enough? Because we do want to, plan well for the future. And we teach our portcos, you don't have to have 100% accuracy and data, but it helps inform how your business operates. But from your perspective and your experience working with pre-seed and seed stage companies, what do you feel like they should really focus on?
Yeah, I mean, at the earliest stage, sort of, the key output you're looking at is cash runway and headcount. A lot of times you're pre-revenue at this point, so you're not even forecasting revenue, and a lot of times you're not necessarily even staffing up a lot because you're at sort of that early stage that you're really sort of trying to build out the product and sort of test it out. And so a lot of times you may not even need a financial plan at that early stage. You may more rely on sort of what's your current cash balance and what's your current cash burn. So you might say, I have $1 million of cash right now and I'm burning, $25,000 a month. So this is, the number of months of runway that I have, or whatever the case may be. But you may not actually need a detailed financial plan. And even if you do need a more detailed financial plan, so if you are planning to staff up a lot so that your expenses are going to be shifting over time, it's really going to be about headcount, most likely. And so you might, pull together a quick and dirty headcount plan with some generalized assumptions around, how you're going to be staffing up over time and how that's going to, change your monthly expenses. And then, build that out to sort of look at sort of what does that mean for your cash runway. But I could see, easily, at that pre-seed stage, pre-revenue stage, if you're really just about, a few people building out a product, you should be able to pull together, a quick and dirty, outlook, on one tab of an Excel spreadsheet, really, really streamlined is what I'd recommend.
Great. I'm going to ask one last question I think is really interesting. Hopefully, you would have a very quick answer because we are out of time. The question is this: what are some of the biggest regrets that you've seen with later stage founders that they wish they did earlier?
From a planning perspective.
Yeah.
Um, yeah, I think what I'd say is not pivoting quickly enough. So if you're, in the middle of the year, you've set a plan, you have optimistic founders that founders are inherently optimistic going after sort of a certain path, and revenue starts coming down, and they have a hard time pivoting their plans. So they end up hiring people that maybe they shouldn't have hired, and then end up having to lay people off that, as once they recognize that they're not meeting their desired goals and they have to pivot to a downside plan. So I think it's sort of being proactive and quickly pivoting is what I've seen. Not that I see it all the time, actually. And luckily I've been able to work with a lot of founders that are good at those kind of pivots, but those who aren't, it can be pretty painful.
Yeah. With that, Debbie, thank you again for joining us. So thanks for everyone who joined us, and we'll see you at the next Growth Series webinar. Thanks, everyone.